Okay, Ryan, so I feel like the conversation is we're disciplined from shale producers. From where you sit, are people disciplined?
Well, I think they are right now. I think people are still have the institutional memory from a couple of years ago with the downturn that occurred and being slow to get back into it, not trying to get out ahead of their skis. With that said, I think cash flows are up because the costs are down, the efficiencies have taken hold, and I do believe the E&P industry will invest most of that cash back into the ground. So the real question is, how much does the U.S. grow today or this year in terms of production, and what percent of the demand increase does that represent? And I think the U.S. will grow in excess of 1 million barrels a day this year, given the price signals that we're seeing, the hedges that are in place, the cash flows that the E&Ps have locked in. So I do think the U.S. is coming back very strongly and will consume most of the incremental demand in the market today.
So in terms of issuing equity, issuing debt, acquiring M&A, is that going to be as prevalent as we've seen? Well,
I hope that we have learned our lesson and we don't get bloated balance sheets. So I would think that people be careful about debt. I would hope that they don't go float equity and just live within their means today. And so that's where the discipline, I think, will maintain with the E&P sector as we go forward. So that's my hope. M&A, pretty tough when the slope of the price is kind of going up. The conversations in the boardrooms between buyers and sellers is quite far apart when you have uprising prices like they are today. So there may be some M&A around the fringes. I think it's going to be tough in the near term.
Is there an oil price that scares you, where you would have to not be disciplined and you would stay disciplined?
Well, I think when you get to 70s and 80s, we start worrying that the market will kind of take off, and the reductions in the cost, the efficiencies that the U.S. has made, the growth would be pretty dramatic, I think, if you got to $70 and $80 a barrel. So, yeah, you worry about those scenarios, and you worry about scenarios that are back down to 40 and 50. We just have a view the volatility is here to stay. The cycles are getting shorter. So from peak to peak, trough to trough, those cycles are getting shorter, and you can build a company to chase up the cycle on the down, then you got to chase it on the down cycle as well. And we just don't think that's a smart way to run the business. We're trying to stay disciplined and work through the cycles. Have a company that works at the low end, and have a company that also gives investors complete upside to the share, to the price as commodity prices rise.
How does OPEC fit into that world?
Well, I think they have to kind of remain disciplined. They have to keep trying to take the volatility out of the equation.
So that means extending that agreement.
It does.
Longer.
It does. If they want to try to put a baffle on the volatility a little bit, that's their role that they can play.
Here at the conference, because we just had yesterday the OPEC dinner with some shale producers. You didn't attend, right?
I did not.
You did not. So what do you feel like the conversation was like there, in that does OPEC realize that's going to be their new role?
Well, I think the challenge for OPEC, I went to Vienna back in 2013 and told them, that the U.S. would pass Saudi Arabian production in the next 5 years, and got laughed off the stage. And so I think they were trying to understand what's happening in shale, that it's real. I think some of the feeling now is the core spots are going, and maybe it's not got the durability and the length. And I think the message for them is this is a supply source that's going to be around a long time. This isn't going away in 5 or 10 years. And I think it's that education process. As a significant source of supply, it's going to be here for a long period of time.
For this year, you're looking at an exit rate of onshore business to exceed 300,000 barrels of oil a day. That's going to beat your 22% 3-year compound annual growth rate. Aren't you part of the problem?
Well, certainly, yeah. You'd argue that all the companies are part of the problem today in a macro that's growing 1%, right? And I think that's our point, is it's a well-supplied world to meet the demand. The resource, the technology, the innovation has brought on a lot more resource. And the key is that's what we believe. That's why you have to be prepared for volatility.
So how do you protect yourself on the downside? How is Conoco protecting themselves on the downside?
You work at 40. You make sure your company delivers free cash flow. You can pay your sustaining capital to sustain your company. You can pay your dividend to the shareholder, and you can do that at a price as low as you can possibly get.
So all of the other shale players are going to come out and say, we can totally do that. Our break-evens are really low. They're 15, 20, 25. Do you see that in your peers?
Well, I think people are in the core of these plays. Yeah, you can. The question you have to ask them is, what's your sustaining capital through the cycle? So as prices go back down, can you continue to sustain those kinds of low break-evens? And it takes a different portfolio. If you're a pure play shale player, it is tough to, over the long haul, to get the break-even down and keep it down over time. What's unique about our portfolio is the sustaining capital is quite low, the sustaining price is quite low, but that's because we're a global diverse company. We're not just a pure play North American player. We're a very big North American player, but we have LNG properties in Australia, in Qatar. We have oil sands in Canada. We have legacy assets in Alaska, in the North Sea, and in Asia. So it's a unique portfolio that can sustain a low sustaining capital, low sustaining price through the cycles and over time. That's the challenge of pure play shale players, is to be able to sustain that over time. They can do it for a while, but can they sustain it over time?
And that really brings me to what you've been doing with your portfolio, and that's been selling assets. You sold $16 billion in assets last year. Are you done?
We're done in the big programs. We'll always have portfolio optimization that we want to do. We're always trying to clean up the bottom end of the portfolio. If it's not competitive for capital, we ought to be moving it out of the portfolio, redirecting that capital to other parts of the portfolio. But our major efforts are done. We did, in 2017, a phenomenal reset for the company. It was huge. It was important for us to get where we did. We accomplished what we'd set out to do in 3 years in 1 year's time. So we fixed the balance sheet. We're increasing the dividend. We're buying some of our shares back that we believe are undervalued in the marketplace. We're growing our production. So we really got ourselves on our front foot.
And it sounds like it was a seller's market then for you.
Well, it was. We were in a good position. We had some very high quality assets that had a lot of interest. So we were fortunate to sell. And I remind people, we've been on this journey since 2012 when we spun the company and sold about $30 billion of assets. Most of that sold at a $105 market.
Wow. Okay, interesting. Especially when people thought you were crazy back in 2012.
Well, yeah, we exited deepwater. We did a lot of things that people thought we took some criticism for as a company, but it was a belief in our belief in volatility, lowering mid-cycle prices with time, and a need to be able to get a company that works at some of these lower end prices.
So would you be acquiring any kind of assets?
Well, we've been in the market. We're always in the market acquiring. We just did a deal where we aggregated up. We bought out a minor interest owner in Alaska. So yes, we're in the market every day buying things. The M&A market's kind of an interesting one. If people talk about very big multi-billion-dollar M&A transactions, I think those are tough today. But certainly bolt-on transactions in and around your legacy assets, yeah, we're persistent and patient.
So what bolt-ons look good to you? Like what areas?
Well, certainly Alaska's a legacy core area for us. North Sea, Norway side of the North Sea, stuff in Asia Pacific as well, and things we're doing in Canada and the lower 48. So we've bought some undeveloped acreage in both Canada and lower 48, trying to build on our unconventional position there as well.
Since you have such a broad view of what's happening across the globe, what areas are seeing cost inflation and what areas are still in a deflationary mode?
Well, we see, yeah, and that's the advantage of a global diverse portfolio, because we see exactly that, Alex. We see areas, if you're a Permian Basin player, you're experiencing inflation in certain categories of spend, like pressure pumping and sand and some of those areas. But as I go around the world, we're still flat to deflating in Alaska. We're flat to deflating in certain parts of Asia. In the North Sea, it's been relatively flat. So when we look at that, if you have a global diverse portfolio like we have, inflation is not a big factor in terms of driving our capital programs this year.
So let's talk about another potential source of inflation, and that comes from the form of potential tariffs here in the U.S. President Trump talking about 10% for aluminum imports, 25% for steel imports. What does that do in an inflationary world for you?
Well, it's tough. We have to see the details of the plan. We don't exactly know what it's going to look like. So we're anxious to see the details, because there's certain kinds of pipe that we use in our business for pipelines that are high specification pipelines that U.S. manufacturers don't produce today. So absolutely, if we see a tariff on those particular pieces of equipment coming from those countries, it's going to increase our costs, which we don't think is good at the end of the day, and want to figure out how to try to mitigate that. So generally speaking, when we look at that, we have to understand the countries that are involved and the actual specific products are involved to see what kind of impact it's going to have.
So where would that hurt you? Would that hurt you on your margins? Would you eat it? Would you have to pass it on?
Well, we don't pass on. I mean, we just produce into a very large market. So we're price takers, not price makers when it comes to that. So for us, it just raises the cost in the system. So we have to offset that with efficiencies and other technology advances that we're using in the company to offset those increased costs.
Do you also feel like, broadly speaking, in the U.S., if we saw tariffs come down like that we'd have to see a deeper discount for WTI to offset that kind of risk? And in that way, that would affect your end cost.
Well, I don't necessarily see a discount in the WTI or from a Brent WTI differential. I think we would see the cost of business start to rise, and it would offset some of the gains that we got from the tax relief act that the president passed through the administration. So, you have to put all that into the mix. So we've had some great regulatory relief by this administration. The tax bill was huge in terms of the energy business here in North America and business in general in North America. So we have to take all those things into account in terms of trying to figure out what it's actually going to do to the cost of supply at the end of the day.
And then in terms of your future plans, what's the one thing that could disrupt you?
Boy, I think the value of a global diverse portfolio is we've mitigated our risks by virtue of where we're at in the portfolio. So I can't really, there are certain things around the country and the world from a regulatory side, from fiscals and ESG and some of those issues. But I think by having a global diverse portfolio, we were able to manage those quite well.
And when you mean by ESG, you mean peak oil demand to switch over into
more sustainable investing? No, I mean some of the social and climate change issues that are coming today forefront in our business. It manifests itself in peak demand and what that looks like. So I think those are the issues we're trying to manage as a company and as an industry as we try to figure out how to deliver reliable, affordable, cheap energy to all four corners of the world, but do it sustainably.